Today we're going to have a look at 5 charts to keep in mind during tough times like now. And this is a report that comes from Dr. Shane Oliver, who is Chief of Investment Strategy and Head Economist at AMP. Key points. Successful investing can be really difficult in times like now, with great uncertainty around inflation, interest rate, issues with global banks, and the risk of recession impacting the outlook of investment markets. These 5 charts focus on critical aspects of investing that are insightful during times of market stress. Chart 1. The power of compounding interest. The chart shows the value of $1 invested in various Australian assets in 1900, allowing for the reinvestment of dividends and interest along the way. That $1 would have grown to $246 invested in cash, to $997 if invested in bonds, and to $781,048 if invested in shares up until the end of February. While the average return since 1900 is double that in shares relative to bonds, the huge difference between the two of them comes down to compounding. That is when the returns of the investment are added to the investment in order to get returns for the next period. The key message is that in order to grow wealth, you have to have investments in things such as shares and property. Now, while shares and property have had a rough ride over the last 12 months because of interest rates, over the long term, they prove to be a better investment. Chart 2. Don't get blown away by cyclical swings. The trouble is that shares can have lots of and often severe setbacks along the way. But over the longer term, returns tend to be solid and relatively smooth. Since 1900 in Australia, if you take a 10-year period, roughly 2 years out of 10 will get a negative return. However, over a rolling period of 20 years, there have been no negative returns. The higher return shares get over a period of time relative to bonds and cash is to compensate those periodic setbacks that they have. The key message is that short-term, sometimes violent swings in the share market are a fact of life. However, over a long time horizon, you will likely meet your investment goals. Time is your friend. So when it comes to investing, it's best to invest for a long time frame. Chart 3. The roller coaster of investor emotion. It's well known that the swings in investment markets are more than can be justified by moves in investment fundamentals alone, like profits, dividends, rents, and interest rates. This is because investor emotion plays a huge part. This chart shows the roller coaster that investor emotion traces through the course of an investment cycle. Once a cycle turns down in a bear market, euphoria gives way to anxiety, denial, capitulation, and ultimately depression, at which point the asset class is underloved and undervalued, and everybody who is going to sell has, and it becomes vulnerable to good or less bad news. This is the point of maximum opportunity. Once the cycle turns up again, depression gives way to hope and optimism before eventually seeing euphoria again. The key message is that investor emotions play a huge part in magnifying the swings in investment markets. It's best not to get sucked into this emotional roller coaster. Of course, this is much easier said than done. Chart 4. The wall of worry. There's always something for investors to be worried about, it seems. The global economy has had plenty of worries over the last century, but it got over them with the Australian share market returning 11.7% per annum since 1900, with the US shares returning 9.9% per annum. The key message. Worries are normal around the economy and investing, and sometimes they become intense, like now, but eventually they will pass. Chart 5. Timing is hard. Temptation to time the market is immense, but timing the market is difficult. A good way to demonstrate this is with a comparison of returns if an investor is fully invested in shares versus missing out on the best or worst 10 days. This chart shows that if you were fully invested in Australian shares from January 1995, you would have received 9.3% per annum. If by trying to time the market you avoided the 10 worst days, that's the yellow bars, you would have boosted your return to 12.2% per annum. If you avoided the 40 worst days, it would have been boosted to 17.1% per annum. But this is very hard, and many investors only get out after the bad returns have occurred, just in time to miss some of the best days. For example, if trying to time the market you miss the 10 best days, that's the blue bars, the returns fall to 7.2% per annum. If you miss the 40 best days, it drops just to 3% per annum. The key message is that it's hard to time the market. It's best for most people to stick to an appropriately well thought out long-term investment strategy. And there we have it. I've just given you some of the key points of the 5 charts from Dr. Shane Oliver. For those of you who are interested in reading the full report, make sure to click on the link provided.